Good afternoon. Big cracks. My name is Paul, and I'll be talking on the balancing of China's current account surplus and policy choices and impacts. And it's slightly different tone to the earlier presentations, which we focused on AI, advanced computer technologies. But I think when we get to the end, we'll see, in fact, that topics blend quite strongly. Now, during this presentation, I'll just talk about just some general ideas about current account balances and growth. Observe that China's got a persistently high savings rate, and then we'll move in from there to talk about some policy scenarios that you can use in an economic modelling environment. And then we'll look at some longer run economic modelling. And so differently from empirical analysis, which we often focus on in our discussions, we're doing some forward-looking work. We'll be looking out to 2070, and we'll be looking at some key results and some policy implications. Now, the current account imbalances in periods of growth are not uncommon. We know that they've occurred in China, but we can also look back. They've occurred in Japan, the United Kingdom, the United States, and Germany has continued current account surplus, but often that's absorbed within the EU. Countries adopt different policy strategies depending on their circumstances for dealing with those imbalances. They can engage in foreign investment, and in another way, in certain circumstances, that it could be capital flight. They can engage in foreign aid, give the money away, or they can move to a more consumption-oriented environment to reduce the source of reduced savings and surplus. But typically, the choices that are undertaken when an imbalance that's systemically significant arises, typically countries will take domestic action, perhaps in confrontation of this, to bring back the imbalance to what would be in terms of global norms. And for a systemically important economy, a global norm would be a current account balance within 5% plus or minus of GDP. China's, as you know, China's current savings rate is high. It's current, and as a consequence of that, it's high. The savings rate is high, and as a consequence of that, there is a current account surplus. Now, China's, as we've discussed, China's growth has been shaped by high domestic savings, extraordinary capital growth, and export demand. And this has taken place since really the beginning of the 1970s, the reform period. There is also within China in the literature concern about declining returns for investments, overcapacity, steel industry, and external volatility. And we can just imagine some of those, particularly on external volatility. Then there has been policy efforts in China. If we look through the literature, if you go back to 2000, there's no shortage of literature that suggests China should lower its raise its consumption rate and lower its savings rate. That sentiment is persistent through the literature, and even in the latest IMF country report, they said the same thing. So there is a difficulty here, and we can get to that when we get to our modelling environments. There's compounding factors, which go low cost of consumption, income inequalities, demographic change, and a large share of national income accruing to corporate sectors. All these are very specific things in country specific. But there's considerable doubt as to how the savings rate in China is going to evolve. It could converge to international norms. It could maintain a high savings rate for the foreseeable future, maintained by high investment. That's the problem. Each of those scenarios could occur while maintaining the current account balance of GDP within international norms. And we'll go into that sort of scenario. There are warnings, though, that just to raise investment through, say, a command structure to absorb savings could exacerbate resource misallocation and raise public debt. However, so balanced against that, which might be a practical matter of public administration, there is evidence that China as a destination for investment with scope for improving the desirability of China as an investment destination, which would give rise to higher investment levels. We'll come to that. And that's given through, say, ease of doing business indexes and financial market indexes. Now, so it's a very diverse story, which you can have, you come to different conclusions. So what I'm going to do in this presentation is work from a scenario approach. And a central tenet of this scenario approach would be that the current account balance needs to conform to international norms. If it doesn't, it's the ingredients for an international crisis. So what I've done, I've observed over the period 1980 to 2019, before COVID, the current account balance sits around about 2% of GDP. So I suggest that it wouldn't be unreasonable. That seems to be an international norm for China. That's a positive balance. So it wouldn't be unreasonable to suggest it's that area. It's not necessary, but not unreasonable. Then we can think of, well, what's a longer run scenario for savings rates? Because in the public policy discussions, what's recommended hasn't been realised and so forth. So we can think of several three, in fact, policy scenarios that you might think about. You think about how China's going to evolve over the next 40 years. So you can think of a lower case of 27%. The significance of 27% is it's around about the average if you get comparable commodity economies like China, Japan, for example. But it's also around about the rate that existed in China's pre-reform era. So this 20%, even though it's much lower than what you can observe in the data, is not out of kilter with what you might find with reference to history in other countries. You could take a median case and then you could look at a higher case of 38%, which is a little bit lower than the average over the reform period. In fact, it's a little bit lower than the post-reform period, 1980 to 2019. The actual average is 42, but that's 42 is very high. 38 is a better number to work with. And it's got other attractions. Okay, so now if you're going to have a current account balance to GDP of 2%, and you're going to have these savings rates, then it defines what your investment is going to be. So we can define investment to be 25% of GDP, 31% of GDP, or 36% of GDP. So that forms some scenarios. So what would the economy of China look like if it came to that? Now, the way you do that is you use an economic modelling approach. So you need a dynamic modelling approach, which compares the growth path of the economy by some standard growth assumptions with and without policy. Take a time horizon, we'll take 2028 to 27, a bit more than 40 years. And we'll use a model called the GDFS model, which is a multi-country, multi-regional, multi-sector, multi-country dynamic model of the global economy. It's out of the GTAP family, but I think now it's more closely to about a third cousin rather than the GTAP models that some of you might be familiar with. We've got China as a separate region, naturally enough, with 5 other regions: Australia, Japan, USA, EU 28, and the rest of the world. The rest of the world is roughly not OECD, so it's got its own characteristics. Some novel features of the model. I think this is really important to have in mind when you're looking at these results, to think of some of these features. So it has a stable long-run growth path, which is not common in these models. It also includes a rate of return for the allocation of savings between regions, because we're talking about allocating savings, and it relaxes the assumption of fixed shares of consumption and savings. So we are talking about consumption and savings being different from what it is now. And the model's got a little bit of, it's been applied in a variety of relevant applications. So what's a baseline for China? Which is, it's worth having a look at this because it's a bit staggering. So take your top part, figure 4A, the population. China's population is going to decline. We've been mentioning that. But with this decline in population, you're going to have a decline in the working age population, and you're also going to have a decline in the work labour force. But looking to the right, 4B, you see the case, how's the labour force going to be falling? Well, what you see is the bottom line is a rise in what we call skills or professional employment as a share of the total population, and most of the decline in the population as a whole will be through the decline in decline in what we call process workers. Right. So I've only got a little bit of time. So we'll have a look at for our 3 scenarios, and I'll just concentrate on couple of these so we get to the end. If we take the low case, 27% case, it's roughly about where the OECD's projections under their moderate growth scenario lies. So it makes very little difference. If we go to the higher savings, GDP could be 18% larger than it would otherwise be. So very substantially. Okay, so let's just, well, I won't go into more details there, but I'd just like to draw your attention to the dynamic growth part. So these are the deviations for GDP. And I'd like to draw your attention to the top right-hand one as you look at it. So you see the red dotted line is associated with the high scenario, and that shows the gross rate of return in percentage points as declining substantially. Now that decline takes China in the model to the neighbourhood of the US, right? So that means a very substantial amount of financial market reform and so on. I won't talk about the other graphs, but what I will say is real income will rise, but because investment's rising under the higher growth scenarios, consumption might be crowded out. Then you'll see that on the right-hand graph with those lines underneath the axis. Now, some of the policy implications to this. There's 2 broad pathways available for maintaining current account balances. You can increase in consumption by lowering national savings, or you can increase investment and absorb those savings, right? Both require difficult policy choices. Now, the first one is the last would take China back to the pre-reform period. So you probably start thinking, you probably have a debate about this, a modern version of a system where there's higher consumption, perhaps in welfare, spending, education, and so forth. But one thing we can observe is that short-run consumption incentives have not worked. There has been a number of them, and they haven't seemed to be effective. On the higher savings regime, there's evidence that financial market reform and improvements in the desirable investment in China is possible, but that require concerted domestic effort. But the other thing is, once I've presented these as binary, but in fact, the choices are not necessarily mutually exclusive. So you get in the low savings group and still have an improvement in your investment environment. And you could go down the high savings route and the high investment route and lower your savings and perhaps then become an importer of capital. So there's a number of scenarios around this, but that will bring me to the end. Is that all right? All right, thanks very much.
Perfect. Thank you very much. It's very exciting to be here. A little bit intimidating, I have to say. There's so many impressive people in the room, but also it's Yixiao as my PhD supervisor, and she's chairing our panel, so I've got to be on my game. My name is Harry Cruz, so I'm a PhD student here. Also, alongside that, I work for an economics firm where I head up global trade service. So I'm hopefully trying to meld some of those 2 things today. What I wanted to start start with is so today we really hope to look through the contemporary challenges in China's export sector, and obviously central to that is what is happening with trade policy, particularly US trade policy, but more broadly a protectionist lens that is coming through the global environment. So this chart, it shows, I suppose, one of the key sources of the chaos in the global trading system at the moment, which is the US effective tariff rate. The average tariff that a good entering the US faces. We started the year at around 2.5%. In a couple of weeks of President Trump's inauguration, we had that 10% tariff imposed on China. That was broadly linked to fentanyl. A month later, we doubled down on that. Another 10% on fentanyl. We had that extended or expanded tariff regime onto Canada and Mexico. Things got silly in April when we had Liberation Day tariffs. We had that tit-for-tat escalation between the US and China. Thankfully, in May, we had that agreement that came through in Geneva and a bit of a pause on the Liberation Day tariffs while they were being worked out. But broadly, over the last sort of 5 or 6 months, we've had the US effective tariff rate bubble around somewhere between 12 and 14%. One of the most recent developments is what happened between US-China relations at the end of October. We had the US agreeing to drop 10 percentage points of those tariffs on China. In return, China agreed to pause those rare earth export controls and boost some of its soybean purchases. Also, very good news in they scrapped the shipping docking fees that were introduced in mid-October, causing headaches for some of the shipping lines. I suppose the big question is, well, what is likely to happen with tariffs going forward? Is there any point in me standing up here talking about tariffs if the Supreme Court, in a couple of weeks' time, decides that they're unconstitutional? If you believe the betting markets, that suggests that the US Supreme Court will find that the IEEPA tariffs that President Trump has used for those country-specific tariffs are likely to be found unconstitutional. So should we, scrap talking about this and talk about how China can continue export? Probably not. Where there is a will, there is a way. And I think President Trump certainly has a will to continue his tariff agenda. And there are several ways that he can do that, even if the IEEPA mechanism that he's invoked recently to do that is deemed unconstitutional. So they could use Section 122 tariffs, which allows the president to put 15% tariffs on countries where the US has a large and serious trade deficit. He could use Section 301 tariffs if there's an investigation and the trade organisation finds that there is some unfair trade practices occurring. They can impose tariffs that way. You could also see it doubling down on Section 232 tariffs, which are the national security linked tariffs, the good-specific tariffs that we're saying. So that's broadly to say tariffs are very much likely here to stay, even if the mechanism that they're imposed with is changed. So what's been the impact of tariffs that we've seen so far? As I mentioned, in my day job, I'm very lucky that we do a lot of trade work, and as part of that, we've developed a daily measure of real-time trade. So we use ship tracking data to be able to see what ships and what types of ships are docking in key ports, and what ships are then leaving those ports. And we get a good measure of maritime trade, which captures around 80% of global trade flows. You see here, this is our data for US imports. We had a flurry of US imports ahead of those Liberation Day tariffs. Firms stockpiled, tried to get in, beat tariffs coming into force. When they came into force, we had a massive dip through April and May. In the lead up to August, that August 1 deadline, we had another surge of US imports. But ultimately, you can see now we're pretty firm in our trend of US imports. This red line is Chinese exports. You can see, broadly speaking, these two have moved in tandem together over the last few years. So when US imports rise, Chinese exports do the same. When US imports fall, Chinese exports do the same. That's really up until, I suppose, the last couple of months or through this year. You can see a real divergence in those red and blue lines, where US imports are falling, but Chinese exports have been incredibly resilient so far this year. Why is that? Well, China's been so successful in finding new buyers for what it sells to the world. This chart here shows Chinese exports by destination, and it shows it over the first 8 months of this year relative to the same period last year. First thing you notice, the massive drop in Chinese exports to the US, down around $52 billion. That's 17% drop in Chinese exports to the US. But have a look at the right-hand side of the chart. You've got big increases to ASEAN, up almost $60 billion. You've got big increases to Asia, excluding ASEAN and India. Europe have seen big gains as well. Africa, Latin America, India, some extent. Now, I suppose the natural question that comes from that is, how much of that is sustainable exports and how much of it is rebound that's occurred because of firms trying to get around very high tariffs on Chinese goods? Well, we can look at that by comparing the good for goods that China is exporting to these countries and those same goods that are then being exported from these countries into the US. So if China is exporting 100 widgets to ASEAN, and ASEAN's increased its exports of those same widgets by 90 to the US, you get a bit of an idea as to how many or what level of transshipments might be occurring at the moment. So we do that for 1,200 commodities, very detailed trade data, and compare the overlap in the increase over the past 8 months. You'll see in ASEAN, around 40% of ASEAN's growth in imports from China exactly match the growth in ASEAN exports to the US. Certainly not to say that's all transshipments by any means. There is some, a large share of that is genuine trade, but it also suggests that perhaps there's not a whole lot of value add in some of that trade that's occurring at the moment. Asia, around a third or 30% of the increase looks to be, I'll have some evidence of transshipments. Europe, around 10%. India, very, very high, close to 60 to 70%, although a much smaller increase so far this year. Africa is a really interesting one. There is next to no evidence of transshipments. If you're shipping through Africa, you may as well pay the tariff. It's going to be more expensive anyway. But a lot of the increase that we're seeing in Chinese exports to Africa reflect the success of China's Belt and Road Initiative. There are a lot of state-owned enterprises that have won contracts to build big infrastructure projects across the continent. Many of those state-owned enterprises are now importing the construction material and machinery needed to build that from China. And that's kind of a bit of a counter-cyclical support that we're seeing. So that's how the destination of Chinese goods have shifted over time. What about the types of goods that China is exporting? So I'll start with the left-hand side chart. It shows the distribution of Chinese exports, firstly in 2000 and then in 2024. And the way to think about this is, if you lined up every good that China exports from on the left-hand side, the least complex, raw materials, very basic manufacturing, all the way through to the most complex on the right-hand side, semiconductors, batteries, advanced electronics, and then you summed up those exports, you get a distribution that looks like this. So you'll see the red line, which is China, turn of the millennium, much more, less advanced export basket, very much in sort of basic manufacturing, apparel, that type of thing. Over the last 2.5 decades, we've seen a huge increase in the complexity of the goods that China is exporting. If you have a look at the second panel there, the 2024 numbers, it much more mirrors the export profile of somewhere like Japan. And if I were to plot Germany on this same chart, you would see a very similar story. China's exports have become much, much more complex. They're not just more complex though, they're also then used in the value chain at different points, which you can see in the right-hand side chart here. So this shows China's exports as a share, broken down by whether they're intermediate goods, so the blue line, whether they are final consumption goods, the red line, or capital goods, the yellow line. And you can see, if you look at the red and blue line, that kind of divergence that's occurred over the last 8 or 9 years. The fact that China's goods are becoming more complex, semiconductors, batteries, the things that are used in production, they are then much more shifting to intermediate goods that are used in production in other parts of the world. The story of China being a sort of mass exporter of final goods to consumers is a story that is diminishing and has been diminishing for quite some time. China's rise in the value chain has shifted the types of goods that it is exporting. All of that I've said is what has happened. not particularly exciting. Really what we care about, particularly when we think about the digital transformation, is what will happen next. As I say, I'm very lucky in what I do, working for working for an economics firm where we put together bilateral trade forecasts at a very detailed level. Don't worry, I'm not an infomercial for it, but just to give you a bit of an understanding as to the methodology that we do for that, we have a structural global macro model that picks up demographic trends and policy trends and how we expect industries at a high level to evolve going forward. We then match that with the global industry model, which tells us how very detailed industry dynamics are shifting, and from that, the types of goods and production that these industries are going to be demanding and supplying. We then use a gravity model to figure out, based on what these industries around the world need and are willing to supply, where they're likely to head to. And we look at things like tariffs and physical distance and political relationships, economic complexity, and historical trading relationships. And what we get is very detailed forecasts for what the global trading environment will look like in the future. And what I want to kind of finish on is say that China will continue to dominate the fastest growing trade routes over the next 5 years. And there's a few reasons for that. Partly, tariffs are making trade more fragmented, which will necessitate the rise of more regional production hubs around the world. Those production hubs need intermediate goods, which China has continued to rise as a share of its exports. Second is policy in China is very much continuing down this path. We heard it at the 15th five-year plan a couple of weeks ago that there is going to be a continued push in advanced manufacturing as a way to drive growth. That is increasingly through intermediate goods, and those intermediate goods will find homes in new regional production hubs around the world. So I've got it. Thank you.
Okay. Two excellent presentations to follow up on. Rather than talk about flows, I'm going to talk about stocks. Specifically, the stocks as they accumulate on China's international balance sheet over time. And if you go back to the beginning of the 2010s, China's international asset position looked formidable in some ways, but there was one problem. There's a relative rate of return problem. China was selling too many assets to foreigners that had very high returns. It was accumulating too many assets on its own balance sheet where returns were very, very low. And as you see in the second paragraph on this slide, despite a net international investment position, a stock concept, of 19% of GDP, the flow of primary income in China's balance of payments in that year was minus 1% of GDP. You infer from that that there is a very, very large and unfavourable relative rate of return gap on the assets China had accrued versus the liabilities which foreigners had accrued upon China. And if you were designing this to the portfolio, you would certainly do something about that. And the measure would be what is going to happen to the flow in the balance of payments on primary income. Is it going to revert to a more positive and structural surplus of income, as we see in Japan's balance of payments? Or was the relative rate of return differential going to continue to be unfavourable to China? And given this is a closed system, favourable for the rest of the world. So I'm going to be examining how the international balance sheet evolved between 2011 and today. And I use 2011 because that is when Balance of Payments Manual 6 kicked in and we started to get the data on more detailed, the more detailed specification of what we had before. So why this question and why now? Well, there's a nostalgic element to this. I spent a lot of my early career looking at Chinese international financial arrangements. My first chapter in a China Update volume was on exactly that question. And so it's always a joy to revisit these old stomping grounds. Secondly, I think there's a gap here. You don't talk enough about stocks in economic analysis, particularly when we want to think about the long run. Flows are fascinating, but it's the stocks as they accumulate over time, which is the best place to look for secular trends. It's the best place to look for changes in high-level policy parameters and national strategy. But you can't check in on the stocks every month. 10 or 15 years is actually a reasonable gap. But take an observation and then take another one and see what's happened. But it's been a very, very busy decade and a half for China in terms of national strategy, high-level policy, and secular trend unfolding. And so it's a great question to look at right now. So you'd all be familiar with at least a portion of these. But each of these bullet points are things that have happened over the last 15 years or so, which you might reasonably expect to impact on China's international balance sheet. We've heard about Belt and Road. We've heard about high-level policy. We haven't heard so much about foreign exchange regime reform and changes in the monetary regime. We'll be talking about digital transformation. That shouldn't be a surprise. We haven't talked about it yet. But there's so many different things which have happened in this 15-year block, which you can actually see the fingerprints of in the evolving international investment position. And the trade war and cycles and a lot of things that we've already covered in a flow sense, we'll see their footprints here. So what has actually happened? Now, these are the main observations that a detailed study of the international investment position has, this is what I've come up with. So the actual net international position hasn't changed very much as a share of GDP. It's actually been remarkably stable at the highest level of aggregation. But there has been a major compositional change, which is exactly what you would expect if you're trying to accumulate just different kinds of assets. You're trying to sell different liabilities to change that relative rate of return discount that you've been offering the world. And what have the biggest changes been? On the asset side of China's balance sheet, the biggest movements have been foreign exchange reserves have lost considerable share in the overall asset position. And direct assets have been increasing their share very substantially. Direct assets are a high return asset class, and foreign exchange reserves, held as portfolio debt principally, are a low returning asset class. So that actually helps you with your return differential. On the liability side, China has been selling more and more portfolio debt for the rest of the world. It's the lowest return asset class. It's the best liability to accrue if you have to accrue liabilities. And China has been accruing fewer direct liabilities, which are the highest returning assets. And on paper, this should be pointing towards a considerable improvement in the relative rate of return on the asset liability stock in China. So this is actually theoretically very positive in terms of China's balance of payments dynamics. But in reality, the primary income deficit remains a deficit, and a substantial one, despite the compositional changes that you would advise. I'll be speculating a little bit about why the relative rate of return gap is still there, despite China doing the right normative thing in terms of the compositional changes in its international assets and liabilities. I'm going to whiz through a few slides now. This is the stability at the top level, but there has been growth. This is in trillions of dollars. And this slide pulls everything together and gives you the stylized return characteristics of each asset class. On the far left, the lowest returning asset or liability is portfolio debt. The highest returning, same side of the slide as myself, is a direct equity asset that you control and own, a real asset. This is where the longest and consistent high returns are to be found. And in the middle, you have some other asset classes as well. 2011, that first row, China had its assets concentrated in the lowest return class and had its liabilities concentrated in the highest return class. And today, for assets and liabilities, we've seen positive shifts in the right direction if you're looking at better returns. What's been growing quickly in terms of the composition? Well, the difference between the asset and liability sides of the balance sheet is, with the exclusion of foreign exchange reserves, which have been moving backwards, everything's been growing on the asset side. So it's actually full court press of diversification in terms of the assets which China has been accruing. But on the liability side, it's actually very concentrated. Debt. Portfolio debt has been growing very rapidly, and you haven't had a wholesale diversification of liabilities. It's happening in one place, and it's mainly happening at the expense of direct liabilities. Just a quick explain here. Nominal US dollar GDP has been growing at a compound rate of 7.75% for the whole period. So if you're growing faster than that, you are gaining market share in the overall system if you're growing slower. And that's why I've shaded certain cells. You can see lots of asset cells are shaded, few liability cells do the same. And this is the change in the stock. So in 2011, 68% of international assets were reserves, and only 9% were high returning direct equity assets. And in 2024, the direct number is up to 31, and the reserves number is down to 34. Really very, very substantial diversification and in the right direction. And portfolio assets have also been on the move from a very low base. But as FX surrender requirements were retired and private agents had more discretion in terms of where they put things, stock connect schemes from into Hong Kong and the like, more portfolio assets are being accrued outside of the reserve pool. And on the liability side, here it is, the portfolio liabilities very much on the march throughout the whole period, enabled by liberalisation of capital flows, inclusion in global indexes for bond and equity investors, which has dragged in capital and made it a lot easier for China to sell portfolio debt to the world. And on the direct side, you still have the majority of liabilities at 52%, which are direct, but you can see that they are losing share. And part of this has been much slower flows into China as the comparative advantage of the change, and you don't go seeking labour arbitrage into China anymore. There's also trade war considerations, but there is also the fact that the incredible competitiveness of the domestic market in China has meant that foreign invested direct assets in China have been making less money. And therefore their retained earnings, which are usually ploughed straight back into the business, have not been growing at the same rate. And therefore they're unable to keep pace with the accruing of portfolio debt liabilities. I'll skip over this because it's a little detailed, but please get your hands on the slides if you're interested in those details. But this is really the final metric. This is the flows on the balance of payments. And the red rectangle, the primary income balance, shows you whilst there has been volatility, China is still experiencing a net outflow of primary income from its assets in 2024, despite a very, very large net international investment position of 18%. And even if you exclude foreign exchange reserves, you've got a very, very large improvement coming through. So it just hasn't corrected. Very sticky. So why are the rates of return not there on this altered composition of assets? Well, I'm just going to speculate a little bit here. I will expand on this later when I turn it into a fully fledged paper. First one, asset selection in outward direct investment. If your motivations for each investment are not wholly commercial, there are many investments which are commercially driven, there will be some which have another component to them, then your average rates of return will arguably be lower than when those investments are wholly commercially driven. You will also have some assets which have no value today, which used to have a value at acquisition. So the more zeros in terms of your investment decisions you have, the lower the average rate of return. Banking claims, which has followed the Belt and Road. We also know there has been a substantial souring of the quality of many of those foreign assets which Chinese banks have been accruing. That's a material part of the international investment position, but it hasn't been performing from a rate of return point of view. And from a portfolio debt side, whilst in theory this is the cheapest way to accumulate liabilities to foreigners, it's actually been a fantastic time to own Chinese bonds. Interest rates have been on a downtrend for a decade. You have a deflationary backdrop. It's a good thing to have bonds and just hold on to them under those circumstances. You make a rate of return which is non-bond-like, i.e. quite high. And so foreigners have actually done very well by accumulating this kind of asset in China. But China hasn't actually received funding which is as cheap as they would like. Given on paper, this is a very good decision, but in fact, bondholders in China have done very well. There is a caveat there. You bought property developer bonds in Hong Kong denominated in US dollars, you did lose your money. But if you own onshore bonds in RMB, you've done very, very well indeed. And finally, whilst there has been diversification of the international investment position, China still owns a lot of portfolio debt as assets. Its FX reserve position is still very large, and counter to the fact that it's been a good time to own bonds in China, it's been a terrible time this decade to own bonds in the West, because the backdrop has been inflationary rather than deflationary, and we also have fiscal discipline to deal with. And so many owners of Western bonds have actually faced capital losses over that period of time. And once again, this weighs on your capability to reduce the relative rate of return gap, which is creating the outflow of the primary income rather than the inflow if rates of return on your assets and liabilities were the same, and the larger stock of assets is going to outweigh the smaller stock of liabilities. So that's my early take on this question. The short summary is China has tackled its relative rate of return problem by diversifying its assets and diversifying its liabilities. To date, that hasn't worked. That the textbook says we come back in 15 years' time. I think that the relative rate of return equation will have improved, and we probably will see a primary income surplus in China's balance of payments. Thank you.
The three speakers for the very related presentations. Now we have questions.
Very interesting papers, insights, that's for all of them. Just a couple of questions on the international Paul's presentation. And there's some tension between getting framework right for China's sake and for the rest of the world's sake, but it's quite difficult for the rest of the world when Britain is having huge trade services and funded development of Argentina, Australia, and Canada, and Africa in the 1930s, 20th century. When the US did that, they manufacturing funded out of US capital flows in the 50s and 60s. Then Japan did wonders for Southeast Asia and the development of the NIEs after they both recorded the huge exports abroad in the late 80s, early 90s. It would be great for global development for China to maintain large surpluses invested in development of the rest of the world. That's not really part of the story. So, and just on the domestic adjustment, you were optimistic about prospects for Chinese private consumption rising, lots of good reasons for that. But there's another path, and that's funding transfers, which may lead to a weakening of the Chinese public balance sheet, but you can get increases in consumption that way. China's done a bit of that. Policy says they'll do more. What's wrong with that as parts of development?
The first point was, what seems to happen, I mean, this seems to be, like the statistical point. There's no doubt that some countries have run current account surpluses, and the recipients of those surpluses, as you described, benefit during the period. And Germany, even now, is written a surplus, and the money is absorbed in the rest of Europe by and large. So there's nothing to say China shouldn't. But the convention, if you look at the sort of the statistics for systemically important economies, and let's say just take the G20 group as the case, it's always within about 5% plus or minus current account GDP. So it seems when it drifts outside that boundary, which China did, I think we're at 9%, it comes back in. So that seems to be, whether it's right or wrong, it seems to be the convention. And I think it's understandable in some senses, if you consistently run these huge surpluses, you end up owning the world, if you like, and that produces its own tension. So I think it's conventional, but it's also understandable. Now, the second point on the consumption, yes, if you think about it, we've been outside the system and only looking at the statistics and the possibilities, and you compare the situation before the liberalisation program, when a lot of the formal social security was bought by firms, so you were a lifetime employee, and that benefit you with health, education, property, housing. After the reform period, that process, was degenerated to some extent. So if you sort of think that the social welfare system of China did change in the reform period. Now, I think the way you describe it is that a new social welfare system will emerge, and that will involve, I just put in the framework I presented, maybe more than household consumption, but more importantly, it might involve more expenditure by government in the form of education and health, and education and health and sort of general welfare services. And you could see that expanding. If the government moved into those areas and increased the security for the wider population and perhaps reduced the income disparities, then you may expect household consumption to increase because households would hold less precautionary savings. Now, but that's you could construct a scenario around that. But one thing we can say, the evidence to suggest that short-term policies, like giving consumption bonds to consumers, hasn't done the job. I think it's the statistic, that seems to be a fact. So you've got to look beyond that, more to the structural things. And so what I think I outlined there was structural change along the lines that you were suggesting. Is that the correct answer? It wasn't a prepared answer. So,
question for you. I'm not prepared to wait around for 15 years for the answer to your questions. I want to express you to speculate a little bit more on what the answer might be and be more clear about it. You mentioned in passing the comparison between the transition of Japan's capital account and China's capital account, and I think that's really very relevant. So, in particular, in respect of the ODI component, what's the experience in Japan with that and the lags to income returns from dramatic increases in the share of ODI as a component of that? Because I think that's what's going to be relevant for the Chinese case as well. A quick question or a quick comment on Harry, which was very interesting. In looking to the future on this, I think the critical question, your data reveals what is becoming increasingly apparent, but what the Trump tariffs have done, it led to a dramatic shift away from US trade towards trade for China in these markets. And what it demonstrates, again, this experience is why, as with Trump's tariffs on China, China's coercion of Australia, it was the rest of the world's openness that made the transition that's taking place possible and led to these outcomes. So in thinking about the future, I think you've got to be a little bit careful about positing the dynamic in trade policy, which reaffirm those outcomes going forward, if you're to be confident of that.
So Peter, here's an answer I prepared earlier. So you just wanted to column headed by Japan for a moment. This is the international investment position of Japan at the outset of that period. And you can see that it has a decent sized position in that direction. The portfolio side actually really is much larger now. And that's the private sector of Japan actually accumulating financial assets, just as the real economy has accumulated substantial manufacturing capacity to real assets outside the country. They still actually have quite a big foreign exchange reserve position. That's never truly been expunged from the system. You can see some countries at other levels of development here as well. For China to get to a Japan-like position, in terms of Paul's comment about China owning the world, 56% of Japanese GDP tied up in international investment position. 56% of Chinese GDP tied up in international assets would be very significant ownership if you actually converted that back to dollars of world GDP, given relative economic performance. So probably you need some sort of adjustment before that occurred.
Completely agree. I think it almost goes back to Graham's comments earlier this morning about the importance of scenario testing as to what a world could look like and different potential pathways.
I'll take last question from the lady at the back.
Hello, I have a question for Dr. McKay. So, we were talking about China has very high savings, and it seems that there are no assets onshore. So the savings will have to get out before addressing the imbalance in China's economy. So I'm just talking about a very roughly picture. But those money getting out of China are not getting good returns because those are low return assets. And simultaneously, foreigners investing in China are still getting better returns. Although there's some housing related problem, they're still getting better returns. So can I have this conclusion that in the next few years, the net investment position in China will get worse because of this asset return imbalance? And this is not a good way to resolve the domestic imbalance in savings.
No, I don't think that's it at all, actually. It's has nothing to do with the domestic savings position, which is, I think, potentially a conflation of Paul's presentation and my own. The key point going forward is that China has made a change in the composition of its balance sheet, both in terms of the assets it owns and the liabilities it is on the hook for to the rest of the world. That change, theoretically, should have made a major impact on the relative rate of return problem China faced 15 years ago. Looking forward, I think that the change in the composition that we've seen will actually start to resemble the textbook relative rates of return on the individual asset classes. We just haven't seen that yet. And I identified some special factors which may have actually contributed to a slower redress of the gap or a mitigation of the gap. Right.
So with all those Chinese companies going global, so the cross-border capital outflow is going that direction out. So that's a net decrease of domestic savings and domestic investments. And as a result, actually, we're not seeing any of the wealth accumulation onshore, but offshore. And in a few years, there might be profit repatriation back to China.
No, I think there's a time dimension to this. So savings and investment onshore, that is a flow concept. These are stock concepts. So think of these numbers as after the fact. Once people have made their investment decisions domestically and their savings decisions domestically, and China has interacted dynamically with the rest of the world, in any given period, China is going to be left with a residual, which is either they're accruing foreign assets or they're accruing foreign liabilities. That's the flow concept through the balance of payments. That then congeals over time in the stock position. But the stock is more than just the sum of the flows, because there are valuation impacts over time and there are rates of return impacts over time, which explains the gap between the stock and the flow. And I've presented the stock data, but I've been focusing most of the sort of judgment in my presentation on the rates of return. And when you have a huge excess of assets in volume terms over liabilities, you would expect them to earn more in gross terms. They're not earning more in gross terms. One day they will. And the way to do that is to buy better assets from a return point of view and to sell worse ones.
Thank you. Thank you to Tracy for some attention, and then we will wrap up this session. Thank you for the questions and discussion.